You're about to realize something. Most new investors today have a financial blind spot when it comes to the stock market valuation, and I've decided to pull the curtain on something that no one seems to be talking about. It's that the people looking at the hands of Warren Buffett for his next move don't realize that there's a scary message in the mere fact that he's not making a move. Perhaps it's because he believes the market's grossly overvalued and expects an imminent crash and correction in the coming months. Now, while this is not financial advice, I've decided to take a deeper look into the factors why they could be. So subscribe to the channel and watch Warren Buffett as what he said this year's Berkshire Hathaway meeting before I tell you more about it.
This question's from Johan Halen, who writes, "You're sitting on $168 billion of cash, which you told us today is now more than $182 billion. His questions are, one, what is Buffett waiting for? And two, why not at least deploy some of it?"
Well, I think that's pretty easy to answer. I don't think anybody sitting at this table has any idea of how to use it effectively, and therefore we don't use it, and we don't use it now at 5.4%, but we wouldn't use it if it was at 1%. Don't tell the Federal Reserve that, but prefer it.
For someone that has always spoken of his aversion to idle cash that isn't employed in a business, it's truly something that Warren Buffett's Berkshire Hathaway has close to $200 billion worth of cash pile up right now. Just earlier this month, Berkshire dumped more than 55% of its stock in Apple, crashing the company's stock price by over 5% overall. That's not an accident, because while most people are looking at Warren Buffett, there's something they don't understand about him. It's that if he believes the stock market right now is overvalued, he still can't just come out and say it. Considering the massive influence he has on the markets, a statement like that could have a rippling effect across the stock market and turn the possibility of a crash into a self-fulfilling prophecy. Instead, we need to look behind the euphemisms and understand that if the market is overvalued by a lot, it may be time to start anticipating a crash in the next few months. And how much? Well, there's a lot of economic and financial indicators for that, but there's one in particular that Warren Buffett has been using for years and almost always predicted the market condition. It's called the Buffett indication. Simply put, it measures the total value of all publicly traded stocks in the US and looks at them as a fraction of the country's total GDP. And it makes sense because if the value of the stocks has risen faster than the economy has grown, it signals the existence of a market bubble that's about to burst. To find the Buffett indicator for today, we need to look at one of the largest broad-based indices in the US, and that's the Wilshire 5000. The market index right now stands at over $55 trillion. The total US GDP right now stands at over $28 trillion. Simply divide the two numbers and you realize that the stock market is valued at nearly 195% of the total size of the economy, which is unsustainable and signals a high degree of overvaluation. That means at a time like this, the inflated value bubble will make a correction sooner or later to the real fundamental value of those stocks, and that focus on a business's fundamentals is what you see throughout Warren's investment philosophy, which is partly why he has named someone like Greg Abel as the successor to Berkshire Hathaway.
That's sort of the story of why we own American Express, which is a wonderful business. We own Coca-Cola, which is a wonderful business. And we own Apple, which is an even better business. And we will own, unless something really extraordinary happens, we will own Apple and American Express and Coca-Cola when Greg takes over this place. It's such a simple approach that it's almost deceptive. Most things, if you keep working harder and harder at it, you learn a little more math or you learn a little more physics. But investments, you don't really have to do that. You really have to have your mind set properly. So we will end up, unless something dramatically happens that really changes capital allocation, a strategy, and we will have Apple as our largest investment, but I don't mind at all, under current conditions, building the cash position. I think when I look at the alternative of what's available in the equity markets, and I look at the composition of what's going on in the world.
If the numbers are to be believed, we'll have to see a massive slump in the stock market of nearly 40% to get back to normal levels of valuation. And perhaps that's why Warren Buffett is keeping his cash idle on the side in order to wait to make the right move. Usually when there's a correction in the stock market, most investors get scared and shrink their own portfolios. But as they say in investing, be greedy when others are fearful and be fearful when others are greedy. A stock market slump could mean that some of the best stocks would reach their actual value and become low-hanging fruits for the brave investors that are ready to scoop them up. But that can't happen unless the investors also had the patience before it to not splurge on overvalued market and not have any liquid cash ready to make the right move in a correctly valued market. I think it's pretty obvious why Warren Buffett can't say a lot of these things out loud given the massive influence his words have, but we can look to what he has said back in 2001 to gauge that investment philosophy.
We obviously are looking every day for ways to deploy cash, and we would never have cash around just to have cash. I mean, we would never think that we should have a cash position of X percent. And frankly, I think these asset allocation things that tacticians in Wall Street put out, about 60% stocks and 30%, we think that's total nonsense. So we want to have all our money working in decent businesses, but sometimes we can't find them, or sometimes cash comes in unexpectedly, or sometimes we sell something and we have more cash around than we would like. And more cash around than we would like means that we have 10 or 15 cents around, because we want money employed, but we'll never employ it, just employ it. And in recent years, we've tended to be cash heavy, but not because we wanted cash per se.
Cash in this sense is just an instrument, and like any instrument, it has to be kept ready for when it's actually needed, which is to buy up stocks when they're valued correctly or even undervalued. The fact that Warren Buffett is the world's most followed investor sitting comfortably idle means he's seeing something that the rest of us aren't. If that's the case, perhaps we can learn more from him and develop the level of patience that's so crucial to investing success. But let me know in the comments how you view all of this, because it's times like these that the moves you make in your market can decide how your financial future turns out.